Hi, my name is Christine Giordano. I'm editor of Markets Group's Institutional Allocator newsletter and head of institutional content for Markets Group's live events. Today, we bring you Bob Maynard. He's a man who transformed not one, but two state economies. In the 1970s, when Alaska was in the midst of its oil rush, Bob was instrumental in building the sovereign wealth fund that we know today. From there, Bob went on to PERSI, Idaho's Public Employees Fund, where he diversified that fund and added benefits for employees that they are still enjoying decades later. Take Bob's lessons learned and try to apply them to today's economy, because in his belief, things are repeating. Enjoy. I'm here with Bob Maynard, who recently retired from his position as Chief Investment Officer of Idaho Public Employees Retirement System. He dramatically elevated the funded level of the state plan and guided the allocations while fulfilling his mandate to become a reasonably diversified, intelligently invested institutional fund. Over the course of his 30-year tenure, he made it happen. Prior to Idaho, Maynard, also an attorney, entered public service in Alaska, where he served the Supreme Court before joining the Attorney General's office and becoming the Assistant Attorney General, supervising oil and gas, among other duties. During his 18 years in Alaska, he helped set up the Alaska Permanent Fund, becoming its counsel and deputy executive director during a time when Alaska was in the midst of the oil rush in the 1970s. That's what transformed the state's economy. This celebratory interview is actually part of the Hall of Fame induction of Bob Maynard, who will be inducted to the CIO Hall of Fame on December 6th in Napa, California, by Markets Group. There, we invite CIOs from all across the country to come and celebrate Bob and his career, because the CIO Hall of Fame recognizes the Chief Investment Officer's influence on the financial industry, his career accomplishments, and overall contributions and collaborations within the broader allocator community. The honorees are nominated by other CIOs. Over the course of this interview, we'll cover how Bob Maynard helped to shape the Alaska Permanent Fund, as well as the Idaho Public Employees Fund, and lessons learned on fundamentals that can be applied to our current economy. I'm Christine Giordano from Markets Group. Welcome, Bob.
Thanks, Christine. It's a pleasure to be here. Thank you.
Let's start from the top. I find it fascinating that earlier in your career, you were the Assistant Attorney General of Alaska, back when oil was just beginning to transform the state. What was crucial for you to put into place back then?
Well, back then, Alaska had been basically, before the oil pipeline opened up, basically a third world country. There was no infrastructure. You couldn't call between villages if you got an appendix eruption and you were in a native village, unless you had the mail plane was there for once a week. You're going to die. So, I mean, you had a number of things that had to be done in a third world country. And all of a sudden, the pipeline opened. And it was like 3 bars came across in a slot machine. And the money kind of rushed in. And so as a result, and Alaska had only been a state when I got there for about 17 or 18 years. It had been a state in 59. I got there in 75. So that was like 18 or 19 years. My math is poor. So in any event, there were a lot of balls up in the air, a lot of things that had to be done. And there weren't that many people there to do it. So as a result, a number of us who arrived in the state in the mid-70s were handed a lot of issues that were complicated, were first-time issues for the state. The bureaucracies hadn't been set up. And so a lot of what was crucial was being able to concentrate on what were most important things and to make them down to a size that they could be easily addressed and easily understood. And so a lot of the litigation against the oil companies on novel issues had to deal with basic concepts that hadn't been around for a number of years. I remember when we were fighting over the oil, the Trans-Alaska Pipeline rate case. A lot of the concepts was how do you set an oil pipeline rate, which hadn't been done since the 30s. And as a result, we had a number of the major capital market theorists as witnesses trying to figure out how do you set a pipeline rate. So a lot of it was dealing with novel issues, trying to understand a lot of novel issues quickly, and going up against some of the best people in the world when you were dealing with those issues. And it was a good training for getting into the investment area later on.
I can imagine. And regarding some of the top issues of the time, how did you protect the state while negotiating this business?
Well, there was an attitude, and this had to do a lot with the governor at the time, Jay Hammond, and a firm belief by a number of the politicians at the time who were tremendous. A lot of Native people were involved in the politics. And the idea was, in the past, they took our gold, they took our furs. We were left basically with nothing. By gosh, that's not going to happen this time. When we're going to set aside a lot of the money that's coming in, because like I said before, when the oil pipeline came on, it was like 3 bars coming across in the slot machine, and all this money came rushing in to a small state with no resources. And so they decided to save a lot of the money that was coming in there, take care of basic needs, but save a lot of the money. So we put in place a constitutional amendment. I think there's maybe one part of that amendment that I had some influence on. I think it was like putting in an Oxford comma. But other than that, I mean, the state made the choice. We were going to save at least a quarter of the oil royalty money for future generations. And in order to do that, they came up with the concept that we're going to share half of the earnings with the population to make a political constituency to be able to get some political support for building up this fund. And that became so successful that not only did we save a quarter of the oil royalties, we ended up saving a lot of the severance tax, the taxes on the pipeline, about a third of the oil revenue into this Alaska Permanent Fund. I think we were the 3rd or 4th sovereign wealth fund in the world. After there was one in Alberta that had gone under, there was one in Nauru that was gone under. Oh, well, that didn't go under. It had real problems. There was one, but Kuwait, that we did some investments in real estate with. I don't know if the Singapore had any of their funds up at the time, but there was the concept of the sovereign wealth fund wasn't there at the time, and we were one of the few that. And they made the choice that whatever we do with this fund, we're not going to invest it inside the state. We're not going to double down on in-state. We're not going to use it as an economic booster, because the idea was if you put the money aside and you invest it out of state, after about 7 years, all the money coming in, it becomes a money pump. We're bringing in money from outside the state back in, that we're giving out half of it to dividends to Alaskans. So it was a great concept made by the politicians, and it turned out to be incredibly successful. And in fact, so successful, a number of the other oil-based states used that model, set up their own sovereign wealth funds. We had a lot of communication with people that were starting out trying to do that. So it was very interesting.
Wow. Yeah. Which states do you remember?
Oh, which states? There were discussions with Saudi Arabia. There were discussions. Remember, we are doing deals with Kuwait. So we had some contacts with some of the, I'm talking about states, I'm talking about nations. There were other states that we're looking at, New Mexico, whatever, but what I'm talking about a number of the other nations that were starting out. So then when Norway so there were a number of conversations with people that were having one-time influxes of natural resource that would eventually deplete. And just a concept. It works. The interesting thing, it worked well in Alaska because you have a relatively small population that you can gain political support. It doesn't work as well when you have a huge population where the benefits of saving rather than currently spending are more diverse, or not diverse, but depleted, not concentrated.
Makes sense. So you were allowed to diversify that portfolio by investing out of state, and
Yeah.
you reap the benefits there as well.
I came up to Alaska around 1975, 1976, and I went to the AG's office in 1976, 77, just about the time the Alaska Permanent Fund really opened up and this money came gushing in to Alaska. And so a lot of the issues was, so they set up the Permanent Fund, and I had some minor involvement in the drafting of the amendment, but I really became involved with the Permanent Fund in the late 70s, early 80s, as they became to realize that the initial investment in the Alaska Permanent Fund was to be as conservative and safe as possible, which meant initially bonds. But then it became clear that inflation was a problem. And in order to keep up with inflation and to be able to continue to give a real benefit to the state of Alaska, they would have to go into equities and diversify out of a strictly bond portfolio. And that was about the time I became involved as the attorney for the Permanent Fund, still in the AG's office, and got into real estate, into international equities, into equities just in the first place. Because back there, institutional investing in the late 70s, early 80s, there was a lot of skepticism of putting institutional funds into equities at all. It was seen as being risky, seen as being, in fact, a lot of state constitutions prevented public funds from being invested in equities because of blowups in the late 1800s, early 1900s. So we gradually went in to equities, real estate, international equities, was the focus in the mid to late 80s.
Yeah, I almost feel, and sorry to be tangential here, but I just kind of see a similarity here with the current economy, with people talking about an impending recession and, the rates you can get, 5%. Isn't that the safe way to play it? And it's almost an echo, or is it? Is there something different about this economy?
Everything echoes around every 8 to 10 years or 12 years. There is that issue as to, my gosh, interest rates were at 14%. They're now down to 8%. It's time to get out of bonds or back into bonds. It's time to go equities. Equities are going to be a disaster for the next 10 years. In fact, that was the view in the late 80s. The whole indexing thing is over. Get out of it. So these sorts of attitudes, the market's viewpoints as to what is the new theme is usually an echo of an old theme that's more than 8 to 10 years old. That's been the case for the last 40 or 50 years, at least in my diminished memory.
Should I ask the question? Are you still bullish on equities in this environment?
Yeah, definitely. Well, it depends again on you've got to have a great idea of what your liabilities are and what the time frame provides those liabilities are. I mean, the standard rule of thumb has always been If you need the money before 3 years, anything except cash or short duration bonds is a foolish investment. If you can last 3 to 5 to 10 years, you get increasingly into equities. And if your time frame is over 15 years before you need your money, like college tuition or whatever it may be, then a majority or almost all equity portfolio is correct. Now, if you're looking at the current environment, there's always big issues that come up. One of the big things that kept coming to me this last year, still is there, is the two rules that you always run, or you always got to follow, is don't fight the Fed. People are still not sure whether they're fighting the Fed. And on the banks, the other one was, if anybody says they're only take your losses, turn around and run the other way. So you still got those issues standing outside. So if I was worried about 5 years, would I put 100% equities now? No. And now I'm 74. Am I going to live 30 years? Probably not. So my asset allocation's a bit more towards bonds and fixed incomes than normally. But that doesn't mean I'm not going to go back into equities once I feel more comfortable. But you got to remember, investing is always like washing your car. As soon as you wash it, it's going to rain. So you got to make sure that you know that you can take the regret.
And just what were some of the obstacles that you overcame when you established the Alaska Permanent Fund?
The obstacles were, one, getting the constituency behind the diversification effort into equities, into real estate, and getting the legislature behind those sorts of activities, knowing that you were going to run into rough stops. For example, being able to handle and have the constituency behind you when 1987 occurred, when October of 87 occurred, being able to, everybody reports to somebody. And you've got to be able to explain what you're trying to do in a crisis in 5 to 7 minutes. Even if you have a good reputation, all that means is, instead of going out and hanging you immediately, they'll give you a chance to explain as they bring out the tar and feathers. And so you've got to be able to explain what you're doing, why you're doing it in a 5 to 10 minute period of time, and why it's important not to make a radical change to the program. And so as a result, pacing into a more diversified portfolio in a manner that allowed the constituency, the legislature, the governor, et cetera, to be behind what we were doing. And I have to admit that Dave Rose was a master at that. And he was the one that is the true hero of that permanent fund. I was along for a lot of the ride, and I was down below, maybe shoveling coal in the theme.
I love it. And then you went to the Idaho Fund. So word on the street is you've got quite a lot of cred for cleaning up that Idaho Fund. They were below 60% funded. They're at the bottom of the institutional ratings. They weren't quite as diversified as was ideal. Let me hear from you. What was it like when you got there?
It was seen as a disaster area by most of the people in the institutional, and it was seen that way by the press and by the politicians.
Why take the job?
It was, well, you don't want to follow Vince Lombardi. You want to follow whatever it was that followed Vince Lombardi, because the bones were good. They had good legislation. They had just changed. They had a new board that was dedicated to doing the right things. They knew to control their liabilities. Like I said, we were talking, for example, the board had put in a policy saying, look, at legislature, you can do whatever you want with the benefits. You got to pay for them. You've got to make sure you're getting the rates up high enough to pay for whatever benefits you're adding. And their basic viewpoint was, we don't have to hit home runs with the investment portfolio. We just want to have, and that's, in fact, that's what the new chair said to me when I came. He said, look, we just want to have good, solid, median institutional returns. We want to be in the pack because it's a fast pack. And I said, hey, I can do that. I mean, don't do anything fancy and be able to explain to people. And so the bones were good. The direction was good. And so as a result, what had happened with this fund was that before I got there in the 80s, they had been all with 4 local bank trust departments who had basically done active management, and they had basically followed trends. So as a result, when equities crashed in the 70s, they went fully into bonds. They never got back into equities for the pickup in the late 80s. Basically, the way they had the bank trust departments had done collectively was that they had ridden trends at the wrong time and changed right when things weren't working. So as a result, when I got there, if they had been in any asset class, including cash consistently, they would have been a $2 or $3 billion better, and they were a $2 billion fund. They had gone away from the bank trust departments and gone to Frank Russell Trust, that bundled sort of outside CIO, where back then there were a lot of sorts of inside fees. There was rumors of undue consideration being given for that, and that had blown up in the major headlines for PERSI. Then they went to an inside CIO model that was standard. It still is generally standard. But the first 3 that they hired left within a year. I was the 4th CIO in a 4-year period. So with that background, what happens when that sort of turnover happens is everybody adds their own thing and nothing gets taken away. So the portfolio was a bunch of bets that basically, you looked outside, there was a structure, but it was like, no, I made sandcastle at the beaches and you drip sand and it looks like a castle. You look up closely and go, man, this doesn't make sense. So when I got there, given that history, given their returns, given their unfunded status, I basically took the portfolio and said, okay, we're going to 70-30 equities, and let's look at all the bets you have. Here is a small cap tech bet. Do you want it? No, we're throwing it out. Here is a Sri Lankan bond bet. Do you want it? No, throw it out. Here's an emerging market bets. You want that? Okay, we'll do that. And so we went through the entire portfolio in the first year or two and went through the bets and narrowed them down to 7 or 8. And then simplified the portfolio to an understandable basis, meant to a primary, heavily indexed, a half index. And then the rest of the 90s was adding a little bit of real estate, real estate is one thing that we were at blind Copenhagen funds, getting out of those and then recasting it as REITs and a separate account. And then a little bit of private equity. We had a board split as to whether our chair was really wanting to do private equity. A lot of them did. It was working through that and then setting up the private equity program. It's that sort of we spent the 90s, mid-90s, putting the portfolio together, bringing in an outside review, setting it up, got the plane up, leveled off, and the next 20 years was basically keeping the plane going on that setup path from the late 90s.
Wow. And how much did your law experience help you there with all the persuasion and the diplomacy and the tossing things out that didn't work and covering the backs of those who needed fiduciary protections?
Quite a lot. And not necessarily for the reason people, you may have noticed that there are a lot of people in the investment world that started out being attorneys, and both in the private side and whatever. What law does, it gives you a way of making sure that every step is covered and being anal retentive. So you don't, and making sure you really understand something and asking questions to make sure that you're not miscommunicating and hearing what you want to hear, or the person you're talking to is not hearing what they think you hear. I mean, it's kind of like saying you talk to someone and they say, I hear you. What they're not saying is, I agree. So making sure that you're not getting those types of misimpressions, that you, which actually helps too on international communication as well. But that sort of background helps a lot. There's other great ways to come into investment, but the law is one that helps a lot.
Interesting.
Plus, as I said before, when I did the Trans-Alaska Pipeline rate case, there was a lot of capital market theory in terms of how to use set rates, because the ICC then hadn't set rates since the 1930s, and all of this new body of academic work with regard to what a capital market return should be was a major part of that case. And so as a result, I had a number of the concepts were familiar.
And okay, I can only imagine your board was used to seeing instant results on returns, stocks, bonds. Okay. But private equity sometimes has what? A bit of a lag there before you can see what kind of returns you're getting.
Not only that, the returns at private equity, you set up a program, are a J-curve. Lemons ripen early. So when you get into private equity, the benefits are 10 to 15 years off. Plus, it wasn't all that clear in the mid-90s when we were getting into it that the dynamics that had led to the great venture capital returns would be there for the buyouts, the KKR type of returns. Remember, Barbarians at the Gate and all of that. It was more a matter back then of our chair, and we have a 5-person board. Our chair was really liked private equity. He had done that as a part of his business. Other board members weren't quite there. So it was more a matter of getting people involved and setting up the infrastructure. Another reason to get into private equity back then too was when you're the biggest fund in the state and you're a public fund, and the economy of the state at that time may not have been on the best footing, you get a lot of individual proposals brought to the board to invest in private stuff, local industry. We have one of the national labs here, local ideas, and you've got to be able to take them seriously. You've got to be able to just not blow them off. You've got, in a small state, a small town, you've got to do that. In order to do that, you have to set up a structure with consultants. And so what we set up was a structure with, basically we were one of Hamilton Lane's first clients, who are a big private equity consultant. We went through there were only a few people at the time that did it. And we basically brought them on and said, look, we want to do private equity, but it's got to be part of a program. And you have to also take into account, we will send you a number of private people. You can say no, but you better give them a reason. And it's got to be some, and if you do say yes, you've got to be able to say, put it on your record. It's got to be a good institutional quality. So as a result, they help set up our private program where basically if someone came in with an idea, we'd send them to Hamilton Lane. Hamilton Lane would give them a full review. And then if they said no, tell them exactly what they were missing. So if they came back and filled what they were missing, we would invest with them. We wouldn't take more than 50% of the deal. And the deal was we will not require 1 penny be invested in Idaho. What we require is that anybody in Idaho comes to you, you do the same thing that Hamilton Lane did to you. You take the proposal with a smile on their face, and if you reject it, tell them why. Don't be honest with them. And so that helped a lot. That was another reason to get into private equity. Getting extra returns from my standpoint was not that important. All I wanted was to get at least public equity returns, because there was another advantage, by the way, too, is the delayed recognition of gains or losses had a smoothing effect. Now, it may be a phony happiness, but the fact of the matter is that's what the actuaries looked at. That's what the accountants looked at. That's what the legislative looked at. And as a result, that's what drove our rates. And so if it smoothed out the rates, it had a direct impact on bread on my teacher's table. So the phony happiness of delayed response was important to us as well, to me as well.
Yeah. Okay. I probably shouldn't talk about private credit and phony happiness in the same sentence.
I'm not a big fan of private credit. The fact of the matter is that we use fixed income and bonds. I've always viewed fixed as the Armageddon hedge. It had to be there when equities went down the drain. And the problem is when equities go down the drain, the types of thing that private credit or high yield credit are involved in also go down. I don't get the area where I know I can reach in, grab the money, and replenish equities on the credit. So the private credit side is not something that we were high on, although we did do Apollo. So that's a different issue.
How did you use it?
Fixed income, and we used bonds, primarily high grade and treasury bonds. We never allowed our managers to go into securities that couldn't be priced daily, that didn't have the liquidity to be priced daily. That was our basic risk control. Liquidity isn't just getting cash. Liquidity also means there's 1,000 to 1,000,000 eyes also looking at the investment and giving you an independent view of what the risk is, what the price is. So as a result, it was that discipline. We had no problems during 2007, 2009. We could rebalance. We could follow track daily. We didn't have to rely on model pricing, and it caused our fixed income managers to be a little bit testy sometimes. But no, we had to be able to be priced daily.
And regarding your real estate investments, did you learn any hard lessons during the great financial crisis? And when and if you rebalanced, what did you do differently?
There's two parts to real estate in the 2007 to 2009. The REITs went down and could be rebalanced into. The more difficult issue were the private real estate where you had more than 50% debt. And so as a result, it was and the problem is when you go into debt, you have the cram down provisions of bankruptcy. So it was working through those issues. And I think the lessons after that, from our standpoint, was that more on the long-term nature of the leases. We had too many leases that were too short-term, that immediately went down, and if people moved out. We were in some properties that the theory going in was, well, that turnover was actually good because if the rates are going up, you capture them immediately. And we were supposedly in a place where if the people moved out, people that were priced out of that market would come back in. It didn't quite work that out, but it didn't work quite out that way. So we had some things that required rolling up your sleeves and working out. But again, it was wholly owned by us. So we didn't have to go into a room with other institutional investors like myself and try to work out. Because while all CIOs of public funds sometimes face similar issues, we all face completely different issues as well, given our particular political environment, our history and tradition, our ability to garner resources or not. So being able to work ourselves out of the problem was a real plus back then.
Mm-hmm. Any tips for this current environment from that one?
Uh, right now, if you get a brilliant idea, do what I tended to do is to go to a dark room, lay down, and wait for the feeling to pass. It's one of those times of until you can see the Fed clearly turn a corner. You know the saying. Anytime the Fed hits the brake, someone flies through the windshield. We've had a couple of people flying through already from cryptocurrency or regional banks. I'm not sure that a higher interest rate environment has fully flushed through the system. As you noted, there's a lot of people that have never been in a higher interest rate, a rising interest rate environment, not to mention a higher interest rate environment. And so it is unclear to me whether or not the tide has fully gone out. So I'm keep sticking to your knitting, sticking to your asset allocation, rebalancing as appropriate, but not doing anything. Try to being a leading edge investor right now, leaping on artificial intelligence. Well, actually, you can lose. I said that wrong. You can lose more being right, but early. You can't being late. In other words, there was a lot. Everybody always said the Michael Lewis book on the hedge funds, on Paulson, and everybody else making a huge amount of money on betting on the credit derivatives. There were a lot of people had that bet a year earlier and couldn't hold it and went under. They happened to be right and luckily relatively on time. But the people that were right on that whole thing and early lost it all.
Page. Okay. So when you retired in September of 2022, your board chair, Jeff Killick, said,
Felix.
for Felix?
Felix, yes.
Felix?
Felix, yes.
Felix.
Yeah.
Okay, I'm gonna do that again then. Thank you. Which leads me to say, when you retired in September 2022, your board chair, Jeff Seelick, said, for 30 years, Bob has played an instrumental role in transforming PERSI into the strong and stable fund it currently is. And Bob's insight into the global economy and steady hand will be missed. So, Bob, as a CIO, you've got everything coming at you at once. You've got to allocate, you've got to delegate. How did you stay up on the global environment?
Well, one was that when I had said before, we had done a lot of things in the 1990s to set the portfolio up like a plane on a level course. And once you set it up on a level course, because again, we were on the range of philosophies on investing. You have people that are really active and want to do a lot of things, but we're more in line with the Warren Buffett of the Shareholder 2013 letter. David Swenson on unconventional success, not his pioneering portfolio management, but his unconventional success book. Burton Malcolm, which is basically, we tried to be simple, we tried to be transparent, we tried to be focused, and we tried to be patient, which means once you set things up, all that you really got to do is rebalance and make sure nothing on the dials are going different. Once you set that up, then your major focus is looking at the things you're not doing. We didn't do more things than we did. Instead of having 15 to 20 type bets, we only had 7 or 8. We didn't do high yield debt. We didn't do frontier markets. We didn't do portable alpha. We didn't do leverage strategies. We didn't even do securities lending because that's a little leverage game going on internally. So basically, you had a lot more time to sit back and look at what other people were doing. Because one of the advantages, at least in the public fund industry, is all the CIOs are brilliant and they're all doing lots of stuff. And when you look across the environment, there's a lot of stuff people are doing. And one thing that is an advantage in public funds, we talk. So you can call up people that are doing things and saying, what worked? What didn't? What are you having problems with? Who's doing a good job in this? And find out, are the reasons that you're not doing that strategy still appropriate for my fund and for our fund for most of the 2000s? And also, too, in the 2000s in particular, you started to see a number of international investment funds being set up from Saudi Arabia. Kuwait was already there. Europe had a huge amount. You had Korea, you had Japan, and we were all talking. We were all going to the same. There were a number of organizations where we knew each other. The whole world is like high school in terms of the investment world. I mean, there may be people that are talking among each other like this, maybe 1,000 to 2,000 of us worldwide at any one time. That's high school. Okay. If you don't know someone, you know someone who knows someone, and you can talk to them. Canada became Canada in the 2000s. So you saw them starting up, and they just went down a different path, and they had more resources. So as a result, staying apprised of, and another major difference between the 80s and now, and the 2000s and now, it used to be information was at a premium. Now, the problem isn't lack of information, it's too much. If you read the Wall Street Journal, you read the trade regs, you read Financial Times, you read Barron's, you listen to Bloomberg surveillance survey, you do those. I don't think there's any secret type of investing you're not going to pick up if you keep on track of what's publicly available. There's not much out there. I mean, yeah, there are right now, if you want a good AI leading edge investment approach, yeah, that's going to be secret. If you want to try to do quantum computing is not going to be here in about 5, 10, 20 years, but you want to do those, yeah, there's secret edges, but getting into those usually loses you more money for the average entrant than it makes. You just saw a number of articles about a number of these AI funds that are behind benchmarks or behind active managers. I don't know if that's going to stay, but most of these leading edge things, the average one fails. One of the most amazing things, Renaissance, I don't know if you ever followed Renaissance Technologies, which I think is the most successful hedge fund, leading edge quant thing in the world. They found out that they thought that the sweet spot for taking the cream off the top was only about $10 billion. Do you know how large the capital markets are worldwide? $100 trillion. If 10 billion is where the cream is, what's the success rate of trying to get into that from the outside, particularly for a public fund, where by the time the information gets to us, you get people together to make a move that you could be someone who gets that cream. It's particularly when the pack itself is moving so fast. So.
Which, of course, makes me curious. Now that you're retired, what are you watching in your own portfolio? Like, what are the trends or do you have theses that you're investing in?
Now, I got a fair amount of money when I came a year ago. I put a third of it into a standard market portfolio. The other, I'm just rolling CDs from a 3 to 1 year period. And seeing, and I think I'm going to do that for a while. Like I said before, two things that I want to see is I want to stop fighting the Fed. I want to see that to be stopped. And I still have that view that I want to see interest rates stay at 5, around 5. maybe go to 6 for about a 1-year period to see if there's any more shadow banking or other glitches in the system that can come forward. I've got enough money that I don't have to worry about uh, hitting a home run, and that I hit a home run, what am I going to spend it on?
Okay. A trip to Napa.
Well, exactly. That's I mean, doing nothing takes more than 24 hours a day. I mean, I have so much backed up on Kindle, on binge watching, on on just doing stuff that I haven't done for years. That I'm perfectly happy.
But you know what, Bob, you took care of your employees at PERSI in more than one way. You guided the PERSI Choice 401k plan.
Yeah.
You fully funded the unfunded sick leave program for state and school employees. What was important to get right there?
Getting good, solid, diversified institutional returns for almost all major public fund programs is sufficient. You don't have to get more, as long as you don't have to react to 1 to 3 year trends in the markets. Keeping on that straightforward approach, it is more than sufficient as long as the liabilities you're trying to fund are no more than are around 3% to 5% above inflation. If you have return needs above that, you've got problems. You either have to go in the markets where the odds are against you, or you better really try to get hold of your liabilities and make people suffer the pain of those liabilities. So as a result, the main thing on getting the sick leave funded, on getting a 401k plan set up, and on the 401k plan is don't make it too complicated. Many of them have 20 or 30 or 40 different options. No, you have at best 5 to 6 and have a standard fund that they can kind of. So, I mean, it's make sure you get the relative straightforward approach down. Don't outrun your supply lines. Make sure you have the resources to do that program. Make sure you can explain it in relatively plain English to a relatively intelligent, non-biased person in about 5 to 10 minutes. And if you can't get that, and then think about doing something more. But investing isn't doing all the complicated leading edge sort of new things where you're getting significantly above market returns. I mean, the problem with investing, particularly oftentimes when you read about it, is it's like listening to people that come back to Vegas who always hit it big at blackjack or hit the jackpot. You know, not everybody. You're one of the people that's going to Vegas. Are you going to count on that? Those casinos are big and fancy for a reason. And it ain't because everybody's coming back hitting jackpot. And it's the same thing with the investment world. There are as many, the failures aren't nearly as publicized as the successes.
Speaking of successes, how large was the AUM on PERSI when you joined?
It was about 2.1 billion, and it was like 22 when I left. And that's the power of market returns over time. I mean, it wasn't as if, and we have a few successes, we had a few things that didn't go right, but for the most part, that's a standard 70-30 equity fixed income portfolio. Turned out, one of the things that was taken as a given was that international diversification was a home run over a 30-year period. Well, it turned out, no. International equities have massively underperformed the Russell 3000. So not everything worked out according to the standard wisdom, but generally, overall, the standard wisdom was right. And I think will continue to be right for the next 30 years.
You had a stateside bias, right?
Yes. For 3 reasons. One is if you look at a defined benefit program, our liabilities are tied to U.S. inflation. Because if U.S. inflation is high, salaries will be higher. and we pay out a percentage of the final salaries. So as a result, if we have to have investments that will be better if U.S. inflation is higher and can be worse if U.S. inflation is worse. Again, we're heavily dominated by real returns. It turns out that over 10 to 20-year periods, one of the best hedges against U.S. inflation are U.S. equities. Someone's making those profits. Someone's driving those, and it's mostly U.S. corporations. And this is before TIPS came out. And TIPS have a real return component and an inflation component. People forget about the real return component, which has really hurt people, but it does have the inflation component. So as a result, U.S. equities are a preferred place to be for U.S. pension plans. It's also the case that a lot of our liabilities are in U.S. dollars, so U.S. dollars are there. And I tend to think that there may be something about the U.S. and Anglo-Saxon financial system, Canada, U.S., UK, Australia, that it's not a fluke that they have outperformed international equities, beside the basic fact we haven't lost a world war. And a lot of the reasons there you see in Warren Buffett, if you remember the Widow Buffett portfolio in his 2013 letters, his portfolio for his widow, which would be the cash he has left over, was going to be 90% the S&P 500 and 10% intermediate U.S. bonds. He had 100% U.S. bias, and he has reasons laid out that I agree with 80%.
A healthy 80%.
Well, he and Munger are the best in the world at active management. There are some home run investments that are not available under under the philosophy sometimes he articulates. Simply buying Berkshire Hathaway doesn't quite, the stocks that are in the Berkshire Hathaway portfolio doesn't necessarily give the returns Berkshire Hathaway.
The current CIO of PERSI is Rochelle Sugiyama. When she was your deputy, what were her strengths that she brought to the position that kind of let you know that she'd be the next leader?
Her biggest strength is she doesn't have a weakness. I mean, she can get the detail. She can get the bigger picture. She's a heck of a lot better interacting with people and the politics than I am. You could throw her into any situation. She would have an instinct to know what to do. A lot of what came off is one of the things that both Rochelle and I did was do a lot of outside nonprofit work. IEEE, Institute for Electronic Engineers, local foundations, university foundations, outside organizations like Pacific Pension Institute. I mean, a number of those, the state's 401k plan and Board of Education, a lot of local nonprofit investment and some outside the state nonprofit investment organizations. One of the advantages of those types of serving on those types of boards is they all have separate consultants. They all have different things coming in, and you get to see investment problems from different points of view. And she has that ability to see different points of view. Plus, she has contacts in the industry that are unparalleled, and she can bring those people in. We have a board of advisors that is as good as there is in the world, that she has brought in to be advisors to the fund that are from her contacts, oftentimes from these other organizations. So as a result, I didn't see a weakness. In fact, I would not know how a meeting went until I talked to Rochelle afterwards, because she would be able to see how people interacted, whether or not people were taking what I thought I was saying the way I thought I said it. Because or they say something that I misinterpreted and say, no, that's not what they meant at all. So it was, she brought all those strings. And I didn't see a major weakness in the 20 years that we worked together. In fact, the last couple of years, I should have retired a year or two. If I'd been trying to make sure I got my full 30, I should have gotten out of there earlier and handed the reins over prior to that.
Oh, you did help guide it through the pandemic crisis.
There's nothing so big you can't ignore. Basically, all the pandemic did was just stick to your knitting, see what happens, rebalance when appropriate. We haven't, let me see, I'm trying to think of it. I don't think we put a new program in this millennium. I mean, everything we've looked at, from portable alpha, hedge funds, leverage ideas, smart beta, all those ideas, none of them survived the 2007, 2008 crisis. Very few of them survived the big downturns, the volatility Armageddon, et cetera. I mean, I don't see anything that's come up in the last 10, 15 years that is time tested, that's crisis tested. And whereas the old standards have been. And so I'm going to be very interested to see, for example, artificial intelligence. I mean, it may be that, active management of all the lists of things you do is down at the bottom of what impacts the fund. But the practice of active management, not only going through the trading environment that's there now, but with the artificial intelligence and the ability to replicate value, whatever it may be investing, to me is going to be interesting to watch. But leaping on what's going to come out of that now or betting your fund on it is problematic. I agree with the funds that are doing little, like having testing portfolios of no more than 5%. We could never do that because we couldn't get the resources. And that's a big issue with regard to a fund like Idaho's. You don't have the resources to build up a big supply line. But those that can do it, I'm interested in whether or not they succeed.
Hopefully they'll find their way and teach the rest of us to force them.
You've been on the industry. What in the last 15, 20 years of a new approach has clearly worked? I can't think of one. I mean, portable alpha, like I said, smart beta, heavily leveraged strategies,
the ribbon,
risk parity. All of those approaches have seen really problematic results. And it tends to be the more complicated approaches. They have an inevitable failure. And sometimes people switch at the wrong times. I mean, for every Ontario teachers, there's a bunch of those Canadian funds that fail, that don't do well, that have problems. I mean, after 2007 to 2009, I went into all the Canadian funds and tried to find the returns. It's impossible to find because they hide them. What their actual return, it turned out that the average Canadian fund from the 2007 to 2012 period underperformed the median U.S. public equity fund. So this Canadian model, it's like all you're hearing are the people coming back from Vegas who hit the slot machines in the 3 bars. You're not hearing about the problematic issues on the Canadian funds. So,
wait, if they hid them, how'd you find them?
What?
How
you find it? You have to go to the accounting statements and then back out the actual returns of the overall fund. And then a lot of them, by the way, you tell they switch their fiscal year, 2009, 2010. I mean, so as a result, you've got to go down to their basic accounting statements, pull them out from the bowels of their organization and get them lined up for the years. There's not and then oftentimes too, when you look at the returns, they're gross of fee returns that are being reported. And that's another issue. You look at peer reviews. I mean, I think our basis point fee for the total fund we have is 27 basis points. The average for most pension funds is 50 to 60, and many of them have 1% or above. Outside CIOs, the average is 1.5%. But if you report gross returns and you look at what takes you from bottom quartile to top, it's oftentimes 30 or 40 basis points. So this whole reporting, who's doing well, who isn't, is a lot. Our returns for the last 2 years, 3 months, and 4 days is top quartile. I mean, it's that sort of. And by the way, I always subscribe to about 3 or 4 different peer review databases, so I can always pull the one about that did best in and send it out. So I'm not saying that we were perfect in that sort of purity. I'm not above that.
Well, it can be so competitive that, yeah, I'm sure everyone.
There's 2 parts to the job. One part is doing well. The other part is having your constituency think you're doing well. And if you have a choice, take the second.
Okay. Diplomatic. All right. Looking back on the more than 3 decades that you served, can you mention some of the things that you've learned that might apply to this new economy, to the years to come?
I guess the main thing I learned is that there are 1,000 right ways to invest, or at least 100, if not 1,000. And the skill in investing, and the skill that has to be done in institutional investing, is you've got to pick the one that is right for your particular circumstances. For Idaho, we had to be on the simpler side because of the resources, because of the type of people that we reported to. Very intelligent people, knew that there wasn't a free lunch, would delegate to you and trust us with the politics and board. But you had to be able to explain it if something was going wrong. So as a result, and we were not going to be able to set up an aristocracy of highly paid investment people who all got paid what the Boise State football coaches got. I was on the other side of that debate in Alaska when I was counsel for the governor and the legislature, and seeing the requests come in for highly paid investment officers. And you look at them, and let's say, look at them and go, excuse me, have you ever put down a prison riot? What's so tough about your job? I mean, do you deserve more than the head of corrections or the head of social services who have to, I mean, you look at that, having these people out in a castle drinking mead and ale, well, it's just ain't going to happen in Idaho. And so as a result, that meant that we couldn't put in place a number of investment strategies that were problematic on their face. There are some places that can do that. The Canadians, for example, can do that. And so their investment strategies for their particular area are different. We're in Idaho. We have a different political climate. We can't put in place what Ailman is doing in California or New York pension funds. So you've got to be able to take all the things that are out there and pick the ones that fit your particular environment, because it's consistency over the years. Are you going to be able to do something that 5 to 10 to 15 years from now with a new board and a new staff will generally be put in place? You look at the really successful funds over the years, there are people that have had their particular investment strategy stay in place for 20 to 30 years. Washington State Investment Board, Cal Sturz, for example. There was a group one time. There's a group called, we theoretically say we didn't exist. It was National State Investment Officers Association. And we had a database going back 40, 50 years, one of the longest databases in the world. And I remember one year, they picked out 5 of the funds that were out there. And we all did something different. We all did something different. One was Washington State Investment Board, had a monster private equity, one of the biggest private equity portfolios in the nation. Another was South Dakota, who has a big in-house value-oriented small cap equity, and they did a lot of merger arbitrage and whatever. Some people did hedge funds. The thing is, over the longer term, we all made about the same returns, just at different times. So a lot of it was just being consistent. The ones that were really towards the bottom kept switching every 5 to 7 years as boards switched over, as staff switched over, as investment philosophy. So whatever you're doing, if you're doing it for a long-term period of time, you're looking at what's going to happen. Make sure it's something you can stick with, that you can explain, that you can get buy-in not only from the current board, the current people you report to, but those that are likely to replace them. And that you don't have to get huge amounts of resources that you aren't able to clearly get to keep it moving. So going forward, my own personal opinion is the basic 5 things. What's your equity fixed strategy? What's your home country bias? What are your first 7 to 8 type of things you invest in? Because the first 4 or 5 types of things you invest in have more impact than the 44th to 45th. Then what's your rebalancing strategy, and how do you keep, because there's a huge conflict on that. Finally, how much are you going to rely on active management, and what type of active management? That's usually the lowest returner. So those sorts of things to look at, and then go down that list and decide, given your liabilities, given your situation, given your likely resources, what's your best investment strategy.
Any other big plans for retirement?
Like I said before, doing nothing takes up more than 24 hours a day. It's a full-time job. So no, we travel to see, we have some places here and there, and we have kids in San Francisco and Seattle, and do the Hawaii trip or the Europe trip every once in a while. But for the most part, just hanging out with Jane, my spouse, is the highlight of my life. And it's better than ever.
Oh, it's wonderful to hear. Well, looking forward to seeing you December 6th.
Looking forward to seeing you and everyone there as well.
For those watching, allocators, come join us December 6th in Napa, where we will induct this wonderful person, Bob Maynard, into our Hall of Fame. Such a pleasure.
Look forward to seeing you, and thank you. It was wonderful.